When it comes to technical analysis, price action is the most important piece. If technical analysis was a human body, then the price action would be the heart. So, in this video, I will be sharing different price action strategies that can be used in different phases of the market. But before we start, be sure to hit that like button and subscribe to our channel, so that you don't miss on any of our new videos. With that being said, let's get into today's video. First, let's understand what price action is. Price action can be simply defined as the historic movement of the price over a particular period of time. Price action helps us in understanding the historic behavior of the price. If we can understand the behavior of the price, then we can effectively predict the future movements of the price. Price action trading generally consists of technical tools like candlestick patterns, support and resistance, trend lines, Fibonacci retracement, etc. But a trader can combine price action and technical indicators to find the best possible trading opportunities. The most important point of price action trading is to identify the phase of the market and trade accordingly. So now, let's discuss the different phases of price action. The price of an asset generally moves in two phases: the trending phase and the ranging phase. A trending phase can be identified when the price is moving in an upwards direction or a downwards direction. In an uptrend, we see that the price makes higher highs and higher lows. On the other hand, in a downtrend, the price makes lower highs and lower lows. When the price is in an uptrend or a downtrend, we will look to enter the trend on the pullback. The price of an asset is in a trending phase for about 30% of the time. For the rest 70%, the price is in a ranging phase. A ranging phase can be identified when the price stays in a sideways range for extended amounts of time. This happens because the price is stuck between a major support and a major resistance level. In sideways phase, we will look to trade at the reversals on support and resistance levels, or we will trade the breakout of the range. Now that we have understood the phases of the market, let's now examine different strategies that we can apply to different market phases. So here are some strategies for a ranging or sideways market. In a ranging market, our first job is to identify the major levels of support and resistance. So in this image we see these two swing highs, and we mark a resistance level by marking the area. Similarly, we see these two swing lows, and we mark the support area. If we want to trade inside the range, we have set our boundaries. So, here, the price comes near the resistance area. We expect the price to face resistance and fall downwards. Therefore, we are looking for selling opportunities. We will not blindly enter a sell trade. Instead, we will create a short-term trend line on the recent up move and wait for its break. The trend line gets broken on this candle. So we sell here and we keep our stop loss above the trend line. We can place our targets at the support level. As you can see, the price touched our target within a couple of candles. Let's now look at a buy trade. Here on this chart, we see that the price faced resistance around this area. And it faced support around this area. So we mark these levels as support and resistance respectively. Now, when the price comes back to test the support level, we expect the price to reverse. So, we plot a short-term trend line on this down move. This candle breaks the trend line. Hence, we enter on this candle. We keep our stop loss below the trend line, and we place our targets at the resistance level. As you can see, the price gave a strong up move after our entry. This is one way of trading sideways market. The other way is to wait for the price to break out of the range. Whenever the market is in a sideways range, we can assume there is war between buyers and sellers. After some time, one of them will win the war and drive the price. Our job as a breakout trader is to follow the side of the winner. So here is a tight price range. We identify the support and resistance using the price action. Then, here we see that the price broke below the support level on this candle. Now, breakouts can often be false breakouts. In a false breakout, the price breaks out of a range, only to fall back into the range. So to avoid false breakouts, we will for a breakout with high volume. For that, we will use the simple volume indicator. So on this candle, we can see that the volume was higher than the previous candles. This is a strong sign of a breakout. So we enter on the close of this candle. We will keep our stop loss above the support level, and we will place our targets at 1:1.5 RR ratio. And as you can see, the breakout worked out in our favor. Here is a buy trade. Here we see that the price created this tight price range. Trading between this range is not possible because the room for profit was very less. Nevertheless, we see a strong breakout of this range on this candle. For confirmation, we see that the volume on the breakout candle was also above average. So we buy the asset on this candle. We place our stop loss below the resistance level, and we place our targets at 1:1.5 risk-rewards ratio. The price made a strong up move after our entry in this case. So these were trading strategies on the ranging markets. Now, let's look at the strategies for trending markets. To trade a trending market, we first need to identify the trend of the market. If the price is making higher high and higher lows, the price is said to be in an uptrend. Another characteristic of an uptrend is that the price constantly breaks resistance levels to create new highs. On the other hand, in a downtrend, we see that the price makes lower highs and lower lows. The price also keeps on breaking below support levels to create new lows. The best way to trade at trending markets is to enter on the pullbacks. So here is a simple strategy to enter on the pullbacks. The first step is to identify the trend. Here we see that the price was making higher highs and higher lows. So the price was in a clear uptrend. For the uptrend to be intact, we expect the price to break above this resistance level. That breakout happened on this candle. Now, the second step is to wait for the pullback. We want the price to pull back to this resistance level that has now turned into a support level. We will look an entry around this area. The third and the final step is our entry trigger. When the price reaches the resistance turn support level, we will create a short-term trend line on the pullback. We wait for the trend line to break. On this candle, the price breaks above the trend line, and we enter on this candle. We will keep our stop loss below the recent swing low, and we will place our targets at the recent highs. This trade achieved our targets. Let's now look at one last example. Here, we see that the price was making lower highs and lower lows. So it is a downtrend. Now, we mark this level of support here. We expect the price to break below the support level and keep the downtrend intact. As expected, the price breaks below the support level here. Now, we want the price to make a pullback to this level. Here, the price makes a strong pullback right at the resistance level. So, we create a short-term trend line. The price breaks out of the trend line, and we enter here. We can keep our stop loss above the trend line, and we place our targets near the recent lows. As you can see, we achieved our profits in this trade. Price action trading does not work all the time. But practice will improve your accuracy and help you achieve consistent profits. That brings us to the end of this video. If you liked this video, then be sure to hit that like button and subscribe to our channel so that you don't miss on any of our new videos. See you soon.